Ready to sell your home here in San Diego? You might be hitting the market at the perfect time. As spring approaches, I'll dive into why now could be your golden opportunity, especially with California dominating the list of the fastest selling markets in the nation. Homeowners and renters here in San Diego, brace yourselves. Insurance rates are on the rise again, and not by a little. And this is statewide. I'll be diving into why thousands, including you, are about to see their premiums soar and what this can mean for the future of homeownership here in San Diego. And if you're a renter, well, this could affect you with a sooner than expected rent increase. This and more coverage here in this week's San Diego Market Matters, and I'm Karl Kyler, your San Diego Realtor. If you're enjoying the updates I bring you in these weekly market reports, prove it. Just kidding. But seriously, if you can like and subscribe to the channel, it means a lot and it really helps me out. And if you're thinking of selling or buying here in San Diego, I have my contact info in the description below. Let's connect and see how we can make your next move happen for you. Now, let's get into the good stuff. Quick market check-in. The Federal Reserve had their recent FOMC meeting where they announced, as expected, no rate cuts for the Fed funds rates. The markets responded positively and mortgage interest rates are continuing to stay below 7%. I'm even hearing people with an FHA loan get their rates to 5.99. PC inflation is at 2.5%, unemployment is chilling at 4.1, and GDP is at 2.3. But the big upset, well, we can at least say it that way, is that the Feds adjusted all of their predictions. Based on their December 2024 projections, they now expect GDP to be lower, unemployment to be higher, and both PCE and core PC to be higher as well. All right, now let's jump into some more exciting news, like how hot sales are doing in California, particularly San Diego. Now, there are 3 rules in real estate. Rule number 1, location, location, location. Rule number 2, everything is for sale for the right price. And lastly, rule number 3, timing is everything. If you're ready to sell right now, you might be knocking it out of the park by hitting the market at the perfect time. Recent data from Realtor.com reveals that 3 out of the top 5 fastest selling markets in the entire United States are right here in sunny California, with homes in these hotspots flying off the market at speeds well above the national average. San Jose leads the charge as the fastest moving market in the country. Homes there are waiting just 22 days for a buyer, despite a median list price of a whopping $1.3 million. Following closely are San Francisco and San Diego, where homes linger on the market for merely 30 and 34 days. These figures are indicative of how fierce competition among buyers is. And if you're a buyer in the market right now, as in you're out there making offers, you know how fierce it is right now. I had a client make an offer on a property in Del Cerro. After 5 days of the home being on the market, they got 10 offers. That means we're competing with 9 other buyers. But it's not only about how quickly homes are selling, it's also about when to sell them. For those of you here in San Diego, today, as in March 23rd, the day this video drops, according to Realtor.com, this marks the beginning of the best week to sell in 2025 here in San Diego. Now, the logic is clear. The housing market is still undersupplied, and a seller listing a well-priced home move-in ready early in the spring can significantly increase their odds of a successful sale. This strategy taps into the spring real estate frenzy when buyer activity traditionally peaks. The benefits of listing early include facing less competition and attracting a larger pool of buyers before the market starts to crowd in the summer months. Remember, preparation is key though, and getting started well before your intended listing date will give you the upper hand. Bottom line, don't rush your home to the market if it isn't ready. Now, what does this all mean for you if you're a buyer? Over the past year, market conditions have gradually improved for buyers, with an increase in available homes and more sellers willing to negotiate, as evidenced by a higher share of homes with price reductions. While housing costs remain high, the market dynamics are shifting, providing buyers with a bit more leverage and time to make considerations. For those persistent enough to continue their search into late summer and early fall, the rewards can be significant. Historically, the number of views per listing cools off during these months, improving conditions for buyers. In 2024, the fall season saw more than a 30% increase in actively listed homes compared to the start of the year, broadening the options for buyers and enhancing their negotiating power. Now, let's be real clear here. Waiting till later summer or fall, heck, even winter will not likely get you a better price on a home. Rather, other conditions will be in your favor, like less buyers to compete with and more homes to pick from. All right, now let's jump into the ongoing homeowners insurance crisis and how it will affect you. In the ever-evolving landscape of California's real estate market, a reoccurring challenge is coming to the forefront yet again, and it could hit homeowners right where it hurts the most. And I don't mean in between their legs, rather their wallets. 2 major insurance companies in California have been cleared by regulators to raise their rates significantly. This decision is set to affect over 666,000 homeowners and renters throughout the state. That's a bit of a scary number there, many of whom are already grappling with the economic aftershocks of recent wildfires. Mercury General, ranking as the 5th largest home insurer in the state, is slated to increase its rates by an average of 12% starting by the end of March. This hike will impact a massive number of policyholders, about 579,300 to be more specific, spanning from homeowners of single-family homes and condos to renters. Similarly, Safeco, a subsidiary of Liberty Mutual, will see an average rate rise of 7.2% beginning in May. These adjustments are largely attributed to the skyrocketing costs of construction, a factor that's become a significant burden for the insurance sector along with new construction builders. It's critical to understand that the rate hikes aren't tied directly to the calamities brought by wildfires, which many people think is the case. Instead, insurers point to the general increase in construction and repair costs. According to Mercury General, these changes have been in the pipeline for over 8 months, influenced by the rising expenses related to plumbing issues and the broader surge in labor and material costs. Bottom line, inflation. As policy renewals roll around, if you're a Mercury General or Safeco customer, you need to brace yourself for these adjustments. But the broader implications are even more concerning. California's insurance market has been in a state of crisis well before these upcoming hikes. Major carriers like State Farm, Farmers, and Allstate have ceased writing new policies due to the increased risk of natural disasters, pushing many homeowners to rely on the state-sponsored FAIR plan, or as I hear many people call it, the unfair plan. This plan, designed as a last resort for those unable to secure private insurance, is itself under strain. The number of policies under the FAIR plan has more than doubled since 2020, reflecting the growing desperation among homeowners in high-risk areas. Recently, the California Department of Insurance announced that the FAIR plan requires a whopping $1 billion injection to cover claims from recent fires, a cost that will eventually trickle down to policyholders in the form of a one-time fee. That could be you. This brings up a looming question. What happens if the proposed tariffs on building materials like lumber, steel, appliances, and such actually comes into effect? The potential for tariffs to further drive up construction costs is very real. If material costs rise, we can expect additional increases in construction expenditures, which will likely prompt insurers to raise premiums even more to offset these expenses. So the big question, and this is where you get to share your thoughts, will the homeowners insurance market impact, influence, or possibly even crash the real estate market? And if you're gonna say that this will crash the San Diego market, back your statement with some reasoning and evidence. Let's hear your thoughts in the comment section below. And that's a wrap for this week's San Diego Market Matters video. Thanks for hanging out with me. If you enjoyed what I bring in these videos and haven't subscribed yet, consider doing so now. But if you're still not convinced, check out some of the other content that I have posted on my channel. I'll post a video here and another one here that you can check out. Hopefully I win you over with one of these. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.